The chapter 16 is about the financing decision and the capital structure. So in this chapter, we are going to talk about the capital structure decision, which is to decide whether you have to raise debt financing or equity financing. And there are 4 topics particularly, and the first 3 topics are about a more classical theory about the capital structure decision, and the 4th one, the last one, is about another alternative explanation about the capital structure. So let me begin with the first topic. So here, let me check about what the capital structure is. So the capital structure is the mixture of debt and equity in capital. So as you already know, a firm has a equity capital, which is their own shareholders' money, and the others' money is known as the debt or liabilities. So the capital structure is the mixture of the debt and the equity capital. For example, our company has a 70% equity and 30% debt. This is the capital structure. And the capital structure decision is to decide the particular ratio between these two, whether you prefer debt or you prefer equity. So this is called as a capital structure decision, and we can briefly say that this is about choosing an adequate level of leverage. So should we raise leverage or should we lower leverage? So this is the core in the capital structure decision. And there have been a lot of attempts to explain why some firms have a larger leverage level, on the other hand why others are showing a smaller usage of the debt, or sometimes they do not use that at all. So the classical theory is established by 2 economicians who are Modigliani and Miller. And so this is why the theory's name is known as the M&M theory, or Modigliani and Miller theory. So this is a classical theory that explains how a firm chooses its capital structure. And both of them won the Nobel Prizes in economics. Franco Modigliani received the Nobel Prize in 1988, and Miller later received also Nobel Prize in economics in 1990. So actually, Martin Miller was a student of the Modigliani. And together they published 2 research articles. The first one is titled as The Cost of Capital, Corporation Finance, and the Theory of Investment. So this is about the capital structure. However, at the time there was no term known as capital structure. So instead they used the terms like cost of capital, corporate finance, and the theory of investment. And this is published in the American Economic Review, which is the best economic journal around the world, in 1988. And later, several years later, they found an error. And a lot of criticism have been done to the first version of their research. So they made a correction around 5 years later, and the name of the article is Corporate Income Taxes and the Corporate Capital, a Correction. So they are admitting that they had mistakenly found the result in the previous version, so they are making a correction in the second article. And although the first one is not realistic, we believe that there are certain implications arising from the first version. So I'm going to talk about the first version first, and then I'm going to talk about the second version, which is a corrected version, later. So let me start with the first version of their research. So in their research, Modigliani and Miller proposed that a firm's value is independent of the firm's capital structure, and that's why the title of this slide is irrelevance proposition. And here it means that the value of a company does not change whether or not you had debt or not. So if you have the value of, if you have a levered firm, so it means you have more debt, still the value is VL. And if you have the value, if you have a firm, another firm, but similar characteristics, but the main difference is that the firm has no debt, and in that case the value is VU, and actually both firms will have the same value if other things are the same. So according to this result, irrelevance proposition, it means that there is no optimal or adequate capital structure, because everything will give you the same result. So actually capital structure decision is not at all important. So you don't have to care about the capital structure itself. Rather, you need to focus how to have more cash flows in the future. So sometimes someone use phrases like this: the size of the pie does not depend on how it is sliced. So if you think about the capital structure, this is about distributing your return to your investors, and there are two groups of investors: shareholders and the bondholders, or the creditors. But it does not matter whether you have a larger slice for shareholders or whether you have a larger slice for the creditors if the pie is the same. So that's what this phrase means, and this is the picture that describing the irrelevance proposition. So here we have the same value of the firm regardless of their capital structure. So in the first firm, we have more creditors compared to the shareholders. We have equity of 40% and we have 60% of debt. On the other hand, in the second firm, we have 60% of equity and we have 40% of debt, but it does not matter because two pies are the same. So actually, if you think about how to get a better pie, how to get a larger pie, it does not matter about the size of the slices. You have to think about how from the beginning you have to cook a larger pie. So that's what the irrelevance proposition states. So let me describe why it is actually possible. Sometimes it is very confusing because you cannot believe that the capital structure is nothing to do with the firm's value. So let me imagine a company named Bold Corporation, and the market value of assets worth of $100 million, and it has long-term debt of $80 million. So actually, this company is right now using a lot of leverage because its debt-to-asset ratio is currently 80 over 100, which is 80%. So it is relying on too much on its capital to debt. And let me say that the interest rate is 10%, and there are 4 million shares outstanding. The number of shares is 4 million, and its earnings before interest and taxes, EBIT, was $40 million. And to simplify the situation, let me assume that all net income will be distributed to the shareholders. So in other words, the dividend ratio is 100%. So there will be no retained earnings, but every income, every profit will belong to the shareholders directly. And furthermore, there is no tax. So let me describe the current income statement of the company. So it has EBIT of 40, and because it has the long-term debt of 80 million, and because its interest rate is 10%, 80 times 0.1 gives you 8. So therefore, interest expense is currently 8. And therefore, the taxable income is 40 minus 8, which is 32. And there is no tax, so we skip this. And the net income will be 32. And if we calculate the return on equity, because we had 100 million asset and 80 was debt, therefore we have equity of 20 million. So the return on equity will be 20 over 32. 32 over 20. So it will be 160%. So it's very huge. And earnings per share can also be calculated. So we know the net income is 32 and the number of shares is 4 million. Therefore, by dividing 32 with 4, the EPS or the earnings per share is 8. And shareholders will receive all net income. Therefore, each shareholder will receive a dividend of 8 per share, $8 per share. So this is the current income statement. So the income statement right now at this moment. And here comes a new manager. Recently, this bold company hired a new CEO, Ms. Safety, and she wants to get an improvement in the stability in the company, because right now this company is relying too much on that. She suggests that we have to change the capital structure of the company, and she proposes that we are going to raise equity financing from the market by issuing securities, which is common stock shares, and then by using the money, we are going to pay the money back for the existing long-term debt. So we are going to terminate the long-term debt, and we are going to have more equity in our company. So to find the relevant information, so we need to do several calculations. First, we need to think about the current stock price. So the asset value is 100 million right now, and we have 80 million as debt. Therefore, we have equity, the market value of equity as 20, and the number of shares were 4 million. So 20 divided by 4 gives you $5 per share. And because we are going to sell $5 shares to new investors, and we want to raise $80 million, so we can get the number of new shares to be issued, which is 16 million. And then, because we had 4 millions before, and now we are going to issue new 60 million, so the total number of shares outstanding will become 20 million after the issue. And then the net income statement changes. So according to the proposed suggestion, so EBIT is the same because we didn't do something for our improvement in our operations. We have the same operating activities. So we have the same EBIT. However, now we have eliminated interest expenses because we paid all that we had back. So we don't have interest expense anymore. So our taxable income is 40, and because we do not pay corporate taxes in this world, we don't have taxes, and therefore net income is 40. However, although the net incomes seem to be larger, unfortunately, there's a problem from the point of view of the shareholders, because before this proposed change, the value of equity was only 20. However, now the new value of equity is 100 million because the total assets is worth of 100 million and there is no debt. So return on equity is actually 40 over 100, which is 40%. So it was 160% before, but after this change, the return on equity changes. It dramatically it is reduced from 160 to 40. And earnings per share is also affected. Before the change, the number of shares was only 4. So the earnings per share was around 8. However, now even though we have an improvement in the net income thanks to the elimination of our existing debt, still the number has significantly increased from 4 million to 20 million. Therefore, the EPS, the earnings per share, is only 2. And therefore, each shareholder will receive the dividend of $2 per share only. So it seems that shareholders are taking disadvantages due to the change in the capital structure. So it seems that actually we are losing something from the point of view of the shareholders. However, this is seemingly change from the point of view of the shareholders. And let me explain why. So let's think about a shareholder. So let's say there is a person named Mr. Angry, and he is very upset about this proposed change because his dividend earning was $8 per share, but right now, thanks to Ms. Safety, so his income is only a quarter, so he will only get $2 per share. And actually, he can change this by himself by responding to this change. So what he can do is to go to a bank and he borrows some money from the bank. So let's say that he borrows $20 from a bank, and let's assume that the bank suggests the interest rate of 10%, which is exactly the same as the firm's previous interest rate. And then using these $20, he can purchase 4 shares additionally because the stock price is $5. And then he had 1 share before, and now he purchased 4 additional shares, so he can have 5 shares in total. So let's think about Mr. Angry's investment. So before the change, he was able to have 1 share only, but he received dividends of $8 per share. So his dividend earning was $8. And at the time, he didn't borrow any money. He have done this kind of investment by himself. So there is no interest expense, and his return from investing in this share was 8, and the rate of return is 8 divided by 5, because 5 is the money that he possessed. So the rate of return is 160%. On the contrary, now after the change, he borrowed money from a bank and he purchased 4 additional shares. Therefore, he has now 5 shares, and each share will give him $2. Therefore, his dividend earnings will become 10. And at the same time, he had to pay back the interest to the lending bank. Therefore, because he borrowed $20 from the bank, he had to pay $2. And then what he remains is 10 minus 2, which is 8. So actually, the return can be the same. before and after. And furthermore, the rate of return is the same because in this investment, he started with his own money of $5 and the other 20 million he actually borrowed from a bank. So it's not his own money, so we are going to exclude it in the calculation of the rate of return. So he has the same rate of return of 160%. So as you can see, when a corporation delevers itself, the investors can lever themselves to get the same result from the before and after this kind of change. So this is called as homemade leverage. So the homemade leverage means generally a company will have a certain level of leverage at the corporate level, but on the other hand, sometimes if as investors you are not satisfied with this decision, then you can change the leverage of yourself at home. So you can borrow some money and then you can adjust your return. And then your return can be always the same regardless of the board corporation's capital structure decision. So therefore, from shareholders' point of view, the value of the firm does not depend on its capital structure. It will always the same. And if we consider that the purpose of managing a firm is to maximize shareholders' value, then we can get this kind of conclusion. We don't have to care about the capital structure because whatever we do, shareholders will obtain whatever they want. So that's why the Modigliani and Miller suggest that there is actually no correct or optimal capital structure, and we should not think about the capital structure. But the critical assumption here is that there is no tax. And then 5 years later, they admitted that actually this is not true in reality because their assumption was so critical in obtaining this result. In reality, everyone pays taxes, including ourselves and the corporations. And therefore, we have to think about the effect of taxes, effect on the taxes by having that. And that is what we already know, as we already learned about the interest tax shield. So in their second research article in 1963, they proposed that a firm's value will increase as the firm's debt ratio increases, and typically this is related to the value of the tax shield, so it depends on the tax rate. So here, let's just say your firm's value was VU when you had 100% equity, and then suddenly you decide to increase your leverage, and then your changed firm value will become VL, which is higher than the VU as much as T times D, which is the size of the interest tax shield effect. Therefore, in that case, if this is true, then the optimal decision, the rational decision, is to use leverage, in other words, use liabilities that as much as possible to get a higher firm value. And in this situation, the target debt to asset ratio should be very close to 100%. Unfortunately, it cannot become 100%, but because at least you need $1 as an equity. So your debt to asset ratio should be 99.9999%. So let me describe the previous situation of the board corporation and Mr. Angry, but when there is corporate taxes. So when we apply the corporate taxes to the both companies' income statement, there are certain changes. First, before, sorry about this typo, so this is before. So before the proposed change in the capital structure, the EBIT was 40 and the interest expense was 8, and we obtained the taxable income of 32. And then now we have taxes. Let's say the corporate tax rate is 40%, and then the taxes should amount $12.80. And therefore, before the change, the net income should be $19 approximately. And in that case, the ROE is not 160% anymore. It is 96%. And the earnings per share is $4.8. And therefore, before the change, each shareholder will receive a dividend of $4.8 per share. And after the proposed change in the capital structure, the EBIT is same. However, we have get rid of the interest expense. Therefore, the taxable income will be 40, and therefore we pay more taxes because there is no interest tax shield anymore. So the taxes will amount to $16 million, and the net income will be 24, which is higher than the previous one because we do not pay interest anymore. However, actually the return on equity is only 24% because now we have 100% equity firm, and the EPS is 1.2 because we have raised equity financing by issuing new shares of 60 million. And therefore the dividend per share will also only become 1.2. So again, the dividend per share will become a quarter from the previous value to the changed value. And again, Mr. Angry can try to resolve this situation by using the homemade leverage. So he will try to increase his return by relying on the bank's money, but unfortunately this is not possible anymore. So before the change, so he didn't borrow any money, so he had $5, so his dividend earning was $4.8, and it was all he got, and he didn't pay interest expense, so the rate of return was 96%. However, after the change, as we have done before, he can try to increase his earnings by purchasing 4 additional shares by borrowing some money from a bank. Unfortunately, in that case, the return is only 4, so actually he fails to get the same returns from his investment, and the rate of return becomes smaller from 96 to 80%. So, as we can see, Mr. Angry's return has decreased when the bold corporation changed its capital structure from levered firm to unlevered firm. So when bold company has no longer that, now Mr. Angry's return is smaller. Therefore, we can say something like this. From shareholders' point of view, the value of firm will decrease when leverage decreases. In other words, the value of the firm will increase when the leverage increases. And the critical assumption, the critical difference between this conclusion and the previous conclusion in the irrelevance proposition is that now we apply the corporate tax rate. And therefore, in reality, it is more realistic compared to the irrelevance theorem. So as we can see, the reason is because now we have to pay certain amount of money to the government, and that will create the margin or the wedge between what shareholders get and what the company generates. So this can be summarized in this graph here. So the value of the firm will, in the previous example, in the previous irrelevance situation when there was no corporate tax, the value of the firm was the same regardless of the debt. However, now because we are having a corporate tax and the interest tax shield effect, therefore the value of the firm will increase whenever we increase our debt. Okay, so far we talked about the two Modigliani-Miller suggestions about the capital structure. So this is the basic idea that that explains the capital structure decisions of the company. So one thing we are sure is that actually there is an advantage when we use the leverage. When we rely more of our capital to the debt, and then we can enjoy the interest tax shield effect, and therefore the firm value increases. And that's why some companies try to have a higher debt ratio, and by doing so they are trying to make a higher return for their shareholders. But at the same time, we often see that some other firms in reality do not try to increase their debt ratio. Rather, they try to have a lower leverage ratio. And that's why. So that's the third question. And we are going to talk about the other explanation that makes a optimal capital structure. So we are going to talk about the disadvantage in using that in the third topic, which I'm going to do in the next Thursday.